What's up, everybody? I hope everybody's doing well. I just wanted to do an update video on my Fundrise account now that we're approaching pretty much the end of 2020. Overall, Fundrise has done pretty well this year. Obviously, we have a lot of headwinds, right, in the real estate market with the whole pandemic situation that's going on. For 2020, I've made $235 in dividends, another $75 in appreciation. Now, I've been a member of Fundrise since 2017. This appreciation number is definitely down. So when the headwinds started, Fundrise communicated to anybody investing in the platform that they are going to retain cash because they expect some deals to emerge once things shake out within the real estate market, and that really hasn't materialized yet. You're not seeing a lot of the buying opportunities in the real estate market, so they're just kind of holding cash, building up cash, and looking for an opportunity to deploy that cash. So as you can see, I'm still in the balance investing. My account level actually dropped to core, and we'll talk about that on why that occurred and my thoughts on that. So previously, this was an advanced level. So let's flip over to the performance tab here. So looking at the year-to-date returns and the different E-REITs, you can see, a lot of them are performing pretty well. There's a few clunkers here, but overall, I'm really happy. One reason for my overall underperformance outside of the headwinds that are in the market right now are I have a lot of E-REITs that are ramping up. So just to explain this to you, for those of you that are not aware, when an E-REIT is operating, that's generally when you're going to see the higher returns for the most part on average. When it's stabilizing, you're kind of in the middle. So they put a variety of projects within each E-REIT, and when it's stabilizing, it's ramping up. So they're doing things either to improve the property, potentially, raising rents or remodeling areas within the property so they can raise rents. Where when it is operating, generally all that stuff has been done. They've operated to their plan, and now they're letting the plan roll out. So generally speaking, you'll see your higher returns with the operating, a little bit lower generally with the stabilizing. The ramping up is generally when you'll see lower returns on average. As you can see here, there's a few that are ramping up that have pretty solid returns right here. But on average, you'll see the ramping up E-REITs are fairly low returns. So what you'll notice probably through the rest of this year and maybe the halfway point of next year, as these continue to ramp up, it'll be below average returns. And once they start stabilizing and operating, these returns will creep up. So definitely not a concern for me. I don't think it should be a concern for you. It's the normal ebb and flow of the Fundrise platform that not everybody is aware about. So let's take a look at the historical returns. So 2018, I did 10.4%, 2019, 9.8%. 2020 has been fairly flat. I think around the 6-month mark, I was around the 4% total return. I'm still at the 4% total return, giving me an all-time return of 7%. So that's not too bad. 2020 has been a tough year for Fundrise. It's been a tough year for all of us with everything that's going on. And I think Fundrise is no different than any other real estate play, right? There's some challenges with rents. Some of their tenants may not be paying rent. Some of their financial, areas Fundrise financially backed may not be paying back or paying back in full. So it is a challenging year. And like I said, they're also retaining some funds so they can make a splash if things do go south and there's some buying opportunities in the real estate market. If we shift down here to my account value, so as you can see, it's gradually increased. So I started in 2017 just kind of testing the waters, put a little bit of money in here, kind of left it run for most of 2017 through 2019, just reinvesting the dividends. And then I really started roping up at the beginning of 2019. I put roughly between what I put in and what the returns from the dividends were, reinvested, somewhere around $5,000. And again, this year I put somewhere around $5,000. As you can see, I'm just over 10,000 now. So overall, this is probably you won't see me investing that much probably through 2021. I'm just going to let this $10,000 rise. There is some risk associated with Fundrise and the nature of the investment, so I don't want it to continue to grow to be a large portion of my portfolio. As of right now, I'm fine with risking $10,000 in here, and I'll just keep letting it chug along, reinvesting dividends, and go from there. Maybe in the future I'll put a little bit in there, but as you're all aware, my primary investment goal is either through my retirement accounts doing passive index style investing, or through my taxable accounts where I'm more of a dividend investor and selecting individual stocks that I feel are undervalued for the long term. So we're going to continue playing by that playbook, and I'll obviously keep you guys in the loop as we do that. So one last thing I want to look at here, if we flip back to the overview, and I touched on it earlier. So I am down to the core level. What does that mean? So the advanced level, there's a little bit more advanced investments in there. They're generally in, so Fundrise has two different type of accounts, an E-REIT and an E-Fund. To be honest, the E-Funds are kind of a pain in the rear end, because you get all kind of extra tax paperwork at year end from those, and they're also usually delayed. So you get the E-REIT tax paperwork, and then I was waiting to do to finalize my taxes, and I still didn't have the E-Fund paperwork. So it was a royal pain for me to do my taxes. So there was an opportunity this year where Fundrise allowed you to redeem your E-Funds. So you can see here, there were E-Funds that were merged, and as part of this merger, they were merging it into a Fundrise E-Fund. They let you redeem the E-Fund, so you can you'll no longer have that in your portfolio. Now this is still showing because I had some return in Q2, so it's still showing in this report, but I suspect next year it will not show in my 2021 report. I elected to eliminate the E-Funds, one, for simplicity's sake, two, I don't think they were really adding anything to my overall return, and there was some additional risk associated with the E-Funds. So I'm going to stick it out with the E-REITs right now, even though I am over the $10,000 mark and could pivot back into the E-Funds. I am not going to do that. I'm just going to leave it at the core level. Now, there is one thing I have to potentially look into. So Fundrise allows you to invest whether you're an accredited investor or a non-accredited investor. So I'm not going to go into what that means, but essentially an accredited investor, at least as defined by the U.S. government, is somebody who has significant funds, and they set certain criteria to make sure you meet that. And it's a certain amount of net worth or a certain amount of income, and there's various rules associated with that. So I don't want to dig into that because, one, I'm not an expert at it, but I know that I have hit the stage where I am considered an accredited investor, and I could do some risky investments that are only available to accredited investors. I am not going to change anything here in that status right now, but it is something I'm going to look into in the future. But anyways, guys, I hope you enjoyed this video. If you do have any comments or questions, feel free to post those below. More than happy to answer any questions. And like I said, I hope all you guys are doing well. If I don't speak with any of you guys as we move into the end of year holiday season, stay safe, stay happy, enjoy time with your family, and I look forward to chatting with you guys again. All right, take care.